the privilege to introduce Advocate Mehul Patel, sir. Sir has been practicing as an advocate since 30 years. He was elected as the youngest president of the IT Bar Association Ahmedabad for the years 2007 to 2009. Sir has also been a speaker faculty at various seminars and lecture meetings organized by various professional associations. Sir, we are privileged to have you here today. Let me now move ahead with introducing CA Harit Dhariwal, sir, a seasoned chartered accountant with over 16 years of experience, including significant treasury management at Vedanta Limited. He is now a partner at Ashok Dhariwal and Company and a respected leader in the ICAI, having served as chairman of the Ahmedabad branch and currently on the Valuation Standards Board. His expertise spans audit, taxation and financial advisory. Sir, we extend a warm welcome to you. Next, I take the privilege to brief you all about CA Mehul Thakker, sir. Sir is a fellow member of the ICAI, having 25 plus years of experience as a practicing chartered accountant in Ahmedabad. His expertise in the field of direct tax is significant. Sir is the author of comprehensive book on direct tax law and international taxation. Sir has also been a keynote speaker at various branches of ICAI, ICSI and other associations across Gujarat. Sir, we heartily welcome you to the Conclave 2025. Let me now move ahead and take the privilege to introduce CA Aseem Thakkar, sir. Sir has been the managing partner of A.L. Thakkar and Company Chartered Accountants and a former vice president, Income Tax Appellate Bar Association, Ahmedabad. Sir is also the author of the digest Income Tax Appellate Tribunal Decisions, Ahmedabad Bench. Sir, we are privileged to have you here amongst us today. Let me now move on to introduce CA Mitish Modi, sir. Ladies and gentlemen, please welcome CA Mitish Modi, sir, who is a gold medalist, chartered accountant, prolific speaker, an active leader in numerous tax associations. He is a respected authority on taxation, contributing significantly through his practice, publications, and honorary government service. His dedication has earned him national recognition, including the President Award of Recognition. So we heartily welcome you to the conclave today. I now request to present the dignitaries on the dais with the memento. I request Advocate Dr. Karthikeya Shah to please come forward and present the memento to Advocate Mehul Patel, sir. Please put your hands together for Advocate Mehul Patel, sir. With a huge round of applause, let's welcome CA Sridhar Shah, sir, to felicitate CA Harit Dhariwal, sir, with a memento. Advocate Ashutosh Thakkar, sir, to please come forward and present a memento to CA Mehul Thakkar, sir. I now request CA Dr. Vishwesha, sir, to come forward and felicitate CA Aseem Thakkar, sir, with a memento. I request our very own Advocate Mrudang Vakil, sir, to please come up on the stage and welcome CA Mitish Modi, sir, with a memento. Thank you, sir. With due permission of all the dignitaries on the dais, I would like to open the stage for the question and answer round.
Good evening, ladies and gentlemen. At the outset, it's our pleasure to be back again at this mega event, annual event I should say. And without wasting any further time, I will straight away begin with the discussion of the first question which is allotted to me. The question in short is that if a particular assessment is reopened under section 147 of the Act on the basis of certain information available with the department regarding some bogus long-term capital gains, but after considering the replies, documents, etc. filed during the reassessment proceeding, the assessing officer does not make any addition and accepts the returned income without making any addition on the said issue. Now, learned PCIT takes action under section 263 of the Act solely on the ground that even though there was information on the inside portal of the department, yet the assessing officer has not verified the said information and it requires deeper verification by the department and 263 is taken by the CIT. Now whether this exercise of 263 is permissible in law or not. Friends, the answer is very simple, that simply on the basis of some information, some general information available regarding some accommodation entry or penny stock or some bogus donation or anything, if it's a general information available on the inside portal and if it does not link the assessee with the said transaction or does not prove the assessee's involvement in the provision of accommodation entry or anything, then simply on the basis of inside portal 263 is not valid. This has been held by our tribunal in the case of Jayantilal Panachand Shah, ITA number 627/Ahmedabad/2024, order dated 16 December 2024, wherein the tribunal has very nicely discussed the powers of CIT and they have said that even after explanation 2 to 263, the CIT himself should undertake some exercise. He should find out as to what is the error in the assessment order. The order cannot be set aside to find out error, but the error should be found out by the CIT himself before setting aside the order. And they said that unless and until the direct link or nexus or correlation of the assessee is established with the information, 263 is not valid. Now friends, on the aspect of accommodation entry and bogus capital gain, of course it is not on 263, but I thought that I should share a couple of good Gujarat High Court judgments over here on merits of the issue, that whether long-term capital gain can be simply treated as bogus only on the basis of certain information without providing the information, without correlation, without cross-examination. There a couple of two Gujarat High Court judgments are very useful which can be applied. One is Affluence Commodities, which is 161 taxman.com, page 476. And another one is Mamta Rajiv Kumar Agarwal, 155 taxman.com, page 549, where the Gujarat High Court has laid down the same principle, that if there is no evidence to show that the assessee or his broker in any way is involved in the racket of accommodation entry, then simply on the basis of information, addition cannot be made. Thank you.
Good evening, everyone. So the question which has been given to me on the new income tax bill 2025, and I'm sure today everybody would have gone through Ahuja sir's session. So I'm just going to take a few important pointers. And before that, I think before I dive into the technical aspect, let me start with the analogy first. So a very important analogy on the new income tax bill and the Great Indian Wedding. Imagine you get invited to a great wedding and a very grand wedding, and you are thrilled because, to be honest, we all are more interested in food, drama, and all those stuffs. But so, however, drawing an analogy with the new act and the old act, so you buy a designer sherwani, so it's like memorizing the tax provisions of 861 Act. You learn entire family tree. You know all the old tax sections, case laws, and amendments. You rehearse how to avoid the noisy uncles and aunties and all. So we basically know currently how to deal with the assessing officers in the earlier act. And finally, when the big day arrives, you see that the venue has changed. You wanted a grand ballroom, which is now converted into a dhaba. The wedding organizer says, "कोई फर्क नहीं पड़ता, शादी तो वही है, same ही है." So the government says there is no policy change. We are just restructured and rewritten the tax laws. The rituals are same but different. Normally it is 7 फेरास, but the priest announces no big change. अब 4 फेरे मंडप के अंदर, 3 फेरे मंडप के बाहर. But the point remains the same. The food is the same, but the order is changed. They have grouped some food items together. So all these things have happened if you can compare with the old act and the new bill which has come up. And as a true professional, it is our responsibility now to adapt to the change. So before I go on to the important topics, few important documents that we all have to refer before going with, to the bill. First, of course, is a new income tax bill that we have to go through. They have come up with a very good navigator. The Income Tax Department has come up with a navigator which is giving a cross-referencing of the current sections of Income Tax Act with the sections in the Income Tax Bill. It becomes very easy for us to read and correlate those sections. They have also come up with a utility to check the new sections. Press releases and FAQs. So a lot of important clarifications they have given in FAQs which are important for us to read. Now, as they say that textually and structurally there is no change. They have just changed the wordings here and there and maybe made it simplified. So now we have subsections, provisos, explanations which were there, which are now forming part of the section itself. And you all would have seen that the words have reduced, chapters have reduced, but more importantly they have also done away with a lot of sections. So they have added new formulas now. So instead of the entire text, they have converted that into the formulas. And they have introduced a lot of tables. For example, for TDS, currently there are more than 40 sections in the Income Tax Act 1961. They have consolidated in one section, that is section 393, and they have given 3 tables. So table 1 pertains to TDS for resident, table 2 for non-resident, and table 3 for other than the above 2. So in short, they have kind of consolidated a lot of sections. A very, very interesting that I came across is notwithstanding word, which is currently used in the Income Tax Act at more than 400 places. Now, in the new law, that word is not there. They have used irrespective of and all those, mainly in that which is more than 150 places it has been used. Then mainly we know that all the definitions have now been consolidated in clause 2. Previous year, as we know, has been replaced by tax year. On the salary side, yes, entertainment allowance for the government employees, which was earlier allowed, is now not allowed under the new bill which has been proposed. IT services and company secretary have been explicitly included in the list of specified professions. For the gift 56-10, lineal ascendant and descendant we all know. Now they have also specified maternal and paternal, both sides are included in that. The 7th proviso of ITA, as we know that there were certain provisions like if you have electricity expense of more than 1 lakh or if you have foreign travel of more than 2 lakhs, then compulsory ITR filing was there. That proviso is somewhere missing in the new bill, but they have given powers to CBDT to specify provisions under which returns can be filed. For the reassessment, sir will be discussing, but the 1 year has been increased now from 3 to 4 and from 5 to 6. And especially now the next side is on the litigation side, that whether this simplification will ease litigation. So in my view, I think whenever a new law is come up, obviously litigation will initially increase because there are a lot of settled cases, a lot of settled judgments which have to be revisited now. So even by the department and even by the taxpayer. So initially, yes, it will increase, but maybe going on, once we say that it is all settled, the litigation should reduce. Thank you.
Next poser we have serial number 3. All posers allotted to me, they are pertaining to new 147 proceedings, which has been again substituted recently. And it requires tremendous attention because it raised lots of litigation throughout the country. The question before us for a discussion is that we all are aware that notices were issued under the old law between a period of 1st April 2021 to 30th June 2021. And that was challenged because law has already been modified, completely substituted, and the notices were issued under old 147 proceedings. And that was finally challenged before the Aseem Thakkar Supreme Court in Aseem Thakkar case. And later on, again, we know all about Corona period and the extension granted, both in terms of benefit to the taxpayer as well as in completion or initiating proceedings on the part of as department also. That also led to further litigation, and we again ended up with another judgment of Supreme Court of Rajiv Bansal's case. So therefore, the question is, what are the outcomes of Aseem Thakkar case and what are the outcomes of Rajiv Bansal's case? So we need to be careful on this because all the subsequent posers are almost based on all this. Let us take it first of all Aseem Thakkar, because the validity was challenged that whether the notices issued under old law will still survive. Where Supreme Court said that department should be given chance because they have committed error. That was the wordings, bona fide mistake they have committed, I am sorry. So what Supreme Court said, that I am exactly reading the outcomes of Aseem Thakkar. Whatever notices issued between this period, that is 1st April 2021 to 30th June 2021, these notices were deemed to be the notices under section 148A clause number B, that is under new provision. The Supreme Court had assigned a deeming fiction to that these notices are valid and it will be deemed to be a notice under clause B of section 140A of the Act. Supreme Court further said that because under 140A you should be provided the underlying material on the basis of which notice has been issued. The Supreme Court also instructed that from today, means the day when that judgment was 4th May 2022, within 30 days, assessing officers shall provide all information material relied upon so that proper response to the so-called notice can be made by the taxpayer. And taxpayer should be given 2 weeks time. So this is to be kept in mind. Number one, within a period of 30 days from the 4th May 2022, relevant material based on which these notices were issued should be given to the taxpayer, number one. Number two, taxpayer should be given time of 15 days to respond this, 2 weeks time. Exactly word is used, 2 weeks time to respond the notices. Then Supreme Court further said that after considering the reply, and after following the procedure under the substituted law, amended law, 148A(d) order shall be passed. And thereafter, very important direction Supreme Court had given that all the defenses which may be available to the taxpayer under section 149 of the Act and all the rights and contention which may be available to the concerned assessor and revenue under the new law will continue to be available. That means all defenses under section 149 would continue to available to the taxpayer as well. But these are the basic Supreme Court resolved that issue, and Supreme Court deemed the erstwhile law notices as a new notices under the new law. Now matter came to Supreme Court again for similar set of notices in Rajiv Bansal's case. It is I think 3rd October 2024. Now this is to be kept understood properly. This is a little bit quite lengthy, but we need to understand meticulously. Supreme Court again reiterated that after 1st April 2021, Income Tax Act has to be read with the substituted provision only. Means substituted provision will prevail, old provision will not prevail. Now come to TOLA, that is Taxation and Other Law Relaxation Amendment Act. Due to Corona, that act was introduced. That what Supreme Court said for that, these are very important wordings. If any proceeding or any action falls for completion between, now Supreme Court had given a date after reading TOLA, between 20th March 20, between 20th March 20 and 31st March 21, that is exactly Corona period. So if any action falls for completion between 20th March 20 to 31st March 21, then TOLA will apply for that also. That is what Supreme Court stated. Supreme Court further held that TOLA will extend even time limit for grant of sanction by the appropriate authority under section 151. We all are aware that every notice under 148, even order passed under 148A clause D, has to be with the prior approval of specified authority under section 151. Then Supreme Court says TOLA will also apply if action falls between this date, then TOLA will also apply for that, and in that case the specified authority can grant sanction up to 30th June 2021. That is the direction given by Supreme Court. Then Supreme Court further clarified that Ashish Agrawal case is applicable pan-India. I mean, it is applicable pan-India. That also they have clarified. Now, there is a deemed stay and surviving period concept has been discussed by Supreme Court here. Deemed stay is what? Exactly. Deemed stay, Supreme Court says, in Ashish Agrawal, already Supreme Court said that SSC shall be given the notice, underlying information within a period of 30 days, and SSC shall be given further 2 weeks time to respond this notice. So starting from the issue of notice between the period of 1st April 2021 to 30th June 21, starting from that till SSC will submit his response, that is a period called deemed stay. That what court had clearly said. And thereafter, court had written that now time start clicking for the officer, and officer shall now pass the order within the surviving period. Now this Supreme Court had explained with the help of example. That example will be very fruitful. Of course, next case study is also based on that, but let us take it slightly an example so that we can understand. Para 112, Supreme Court says, let us take it that notice was issued on 1st May 2021. Now be careful with the example, that would be very easy to understand. 1st May 2021 under old regime for a particular assessment year. Then Supreme Court says from 1st May 21 till taxpayer will respond this notice, that is a period of deemed stay. Now under TOLA, the last date is what? 30th June 21. So from 1st May 21 to 30th June 21, number of days, Supreme Court says, these number of days are 61 days. 1st May 21 to 30th June 21, number of days are 61 days. These 61 days is available with the AO after SSC replies this notice. Let us take it, SSC replies notice, Supreme Court says, on 18th June 2022. Then thereafter 61 days available with the assessing officer to pass 148 AD order, and that Supreme Court said that it will end on 18th August 2022. If new notice under 148 after following 148A proceeding is on or before this date, then notice is valid, otherwise notice is invalid. We will more understand with the next poser. Thank you.
A search has taken place on 16/10/2018, and during the course of search proceedings, some incriminating material relating to a third party has been found. The AO of the searched person, after recording his satisfaction, has handed over the documents to the JAO of the third person. AO of that third party, whose documents have been found, has received those documents, recorded his satisfaction, and initiated and issued a notice under section 153C of the Act, all before 31st of March 2021. Is the action of the AO valid? These notices have come to be issued for AY 2013-14 to 18-19. That is the issue. Now briefly, let me point out what the provisions of section 153C are. That suppose there is a person, say A, he has been subjected to either search or he has been visited with a requisition proceedings under section 132A. The AO of that person, after recording his satisfaction, he'll note down okay, what are the documents which relate to that third person which have been found during the course of search proceedings, prepare a satisfaction note and forward it to the AO of that person to whom those documents belong or the information contained therein pertain. That AO of that third person will thereafter independently record his satisfaction. He will vet those documents, and after, if he is satisfied, he will again draw up an independent satisfaction note and thereafter issue the notice under section 153C. For 153A or 153C proceedings, therefore, there is a threshold limit that what shall be the date of search. So in case of 153A, they say that the date on which the search was initiated, that would be the relevant date, and you have to go 6 years earlier to that particular assessment year, which would constitute your block period. In case of 153C proceedings, they have come out with a proviso in section 153C itself, where they say that the date shall be construed in case of a in case of a third party, what would be the date which should be construed as the date of search. So they said that provided that in case of such other person, the reference to the date of initiation under section 132 or making of requisition under section 132A shall be construed as reference to the date of receiving the books or documents or assets seized or requisitioned by the AO having jurisdiction over such other person. Now, in light of this, please look at the date. That date which he has received the documents, let us assume that prior to the satisfaction, those books have been received. So, that financial year in any case would be 2021. So, relevant year would be 21-22, and 6 years earlier you have to go from that day. So, that would be 2015-16 to assessment year 2021. So, assessment year 13-14 and 14-15, where 153C proceedings have been issued, only because of the reason that they coincide with the date of search in case of a 153A would be invalid. The years for 153A 6-year calculation is separate and independent from 153C. In 153A, as I pointed out, date of initiation, that would be the last year and 6 years earlier to that. In case of 153C, the date on which you receive the books of accounts from the AO. And this proposition has now been supported by the Honorable Supreme Court in the case of Jasjeet Singh, 458 ITR, 437 Supreme Court. And this matter has also now been decided by the jurisdictional Ahmedabad Tribunal in the case of Suraj Limited, 165 Taxman, 410 Ahmedabad. Another Supreme Court judgment which also goes on that same principle is Gali Janardhan Reddy, 463 ITR, 697. So 13-14 and 14-15 would be illegal and bad in law. The remaining years, they would be definitely covered by 153C proceedings.
Good evening to everybody. Now question number 5. The SSC filed its return of income with a claim of deduction under Chapter 6 of the Act, but however, inadvertently omitted to furnish the audit report in specified form. The return of income processed under Section 143 into bracket 1 of the Act, whereby the deduction claimed has been denied. The SSC filed the rectification application under Section 154 along with the specified audit report or audit certificate. They did not dispose of the rectification application and remained silent. What is the remedy available with the SSC under these circumstances? From reading the query, I believe after processing the return under Section 143(1), denying the deduction under Chapter 6A, huge demand may be raised. So, this is the inadvertent mistake on the part of the SSC not to furnish the audit report or the audit certificate along with the ITR file. It is the settled proposition of law that filing or furnishing of the audit report is the not mandatory but directory, and it is the if not filed with the return of income at the time of return of income filed under Section 139(1) or 139(4), it is the procedural lapses or procedural defects, and on that ground the AO has no right or power, or the CPC has no powers to deny the deduction under Chapter 6A. The remedy available is to file the application for rectification under Section 154. This is the apparent mistake of the facts for not granting the deduction under Chapter 6A. So, the SSC has filed the application under Section 154 along with the audit certificate or the audit report, which is required to be submitted with the ITR for the in support of the claim of the deduction under Chapter 6A. But in this case, the AO has not disposed of the rectification application and remained silent. This is unfair attitude on the part of the AO, what I personally believe. perhaps in this case, the SSC may have filed the appeal against the order under section 143(1), and generally the AO remains silent. Whatever the result from the appellate forum, he will accept the order of the appellate forum. He will not dispose of the application under section 154. But that is not the purpose of the intention of the legislature. When there is the mistake apparent from the records and the SSC has approved the jurisdictional AO, he is duty bound to consider and appreciate the application under section 154. And if the AO does not dispose of the rectification application and the SSC has to face the recovery proceedings just because of the inadvertent mistake on his part, it is not fair. In this connection, I have one citation of Bombay High Court, Pankaj Kailas Agrawal versus ACIT, 464 ITR, page 65. In this case, the High Court held that the AO is duty bound to pass order on rectification application instead of making baseless statements in the affidavit in reply. The court directed that the High Court's order shall be placed before the principal chief CIT to take disciplinary actions against the AO for dereliction of duty, and further directed the AO to dispose of the pending application on merits and after affording the personal hearing to the SSC. So if by not granting the deduction under chapter 6A or any deduction or relief which is legitimately available to the SSC merely on some inadvertent mistake, that is not the requirement under the law, that is not the expectation from one quasi-judicial officer of the department. Please.
File the form for obtaining new scheme. The return process in under new scheme, but they have filed in old scheme. Now what remedy is available to them?
I would request all the participants to
I think
kindly
this is
hold on
somewhat
to your
different
questions.
case. You filed the return under the old scheme, but the return has been proceeded under the new scheme. So it is the apparent mistake of the law. You can file the application under section 154, and I would suggest to approach the principal CIT with the application under section 264. It is prejudicial to the interest of the SSC. You can approach the principal CIT because he has jurisdiction. Because wrongly processed by the CPC, because what is the outcome of the return process by the CPC? There may be huge demand or demand of tax. So you have to simultaneously file the application under section 154 or application under section 264, or you can file the appeal before the first appellate authority.
A humble request to all the participants to kindly hold on to your questions. If time permits, we will definitely open the floor for the question and answer round. Let them first complete with their list of questions. Thank you so much. Yes, sir, please continue.
Okay, I am taking up question number 6. Basically, the issue is that there was a legal issue of reopening under section 147, which has been decided against the SSC by CIT appeal. However, on merits, the entire appeal or the issue has been allowed in favor of the SSC. Now, SSC has accepted the order of CIT appeal, but the department filed a second appeal before tribunal on the merits, which was where the relief was allowed to the SSC. Now, question is that in second appeal by the department before tribunal, is there any remedy to challenge the 147 proceedings before the tribunal? If you realize that 147 is bad in law, or by that time the issue on merits may have been covered against you by some judgment of High Court or Supreme Court, then can you challenge 147 in the appeal by department or not? The answer is yes. There is a very nice rule provided which is seldom used by us, Rule 27 of IT-80 rules. Rule 27 of IT-80 rule says that the respondent, that is the SSE, because the appeal is of the department, the respondent, even though if he has not filed any appeal or even cross objection, still he can support the order of CIT appeal on any issue which has been decided against him. So what we can do is that we can file a simple application under Rule 27, wherein we can take the ground regarding 147, and in such circumstances the tribunal is bound to admit the application and decide the ground on merits, whether 147 is valid or not. And recently this has been done by the tribunal, our tribunal, in what such case? In the case of Department versus Jayanti Bhai S. Patel, ITA number 1093/Ahmedabad/2019, dated 5th July 2024. And friends, the other better option is that whenever you receive departmental memo in respect of department appeal, it is always advisable to file cross objection also within 30 days, which would be much easier. And as far as challenging a legal proceeding is concerned, it can be done at any time. That has been settled by our High Court way back in 113 ITR, 113 ITR, page 22, PV Doshi's case, that reopening, which is the fundamental, which goes to the root of the matter, can be challenged at any time. There, in the case of PV Doshi, what had happened was that first round of litigation was over up to the High Court. The matter was set aside. In the second round, before the AO, it came to light that 147 is bad in law, and 147 was challenged in the second round of litigation, and this was also permitted right up to the stage of High Court. Thank you.
The next question is on the section 28.4, poser number 7. The Finance Act 23 expanded the scope of 28.4, impacting the taxability of loan waivers. Now the Finance Bill 25 proposes restricting the carry forward of losses in mergers, successions and conversions to the unexpired period of 8 years from the day when it was originated, from the year in which they were originated. This curtails evergreening of losses and aligns business reorganizations with demergers provisions. How will these changes impact distressed asset acquisitions, particularly NCLT cases where revival depends on loss set-offs? Will it reduce takeover incentives? So here the question addresses two significant amendments which have critical implications on the restructuring and the distressed asset sale. Finance Act 23 had amended section 28.4. In that, I think pre-amended, it was valued that the value of any benefit or perquisite, whether convertible into money or not, arising from the business or profession. It was now amended that the value of any benefit or perquisite arising from business or profession, whether convertible into money or not, and this line was added which says that whether in cash or in kind, or partly in cash and partly in kind. So because of this amendment, even the memorandum to the finance bill, they had mentioned that time that the intention of the legislature while introducing this provision was to include benefit or perquisite whether in cash or kind. However, courts have interpreted that if the benefit are in cash, it is not covered within the scope of clause 28.4 of the Act. So basically, we all were aware of the Mahindra and Mahindra judgment of Supreme Court, which we said that whether in the waiver of loan, at that time it was not taxable. But this basically nullifies that judgment. So now with this amendment, there is no distinction between the type of loans, and the settled law, which was that loan waivers were not taxable, are now become taxable from 1st April 2023. But in view of this, we also have to refer to one more Gujarat High Court judgment in case of Chetan Chemicals Private Limited, wherein a very interesting fact was noticed. They had mentioned that the waiver of such loan should also arise from the business and profession, so the company should be in the business of that providing those loans, like an NBFC. So again, a very interesting question is there, that whether normal waiver of loan would be a part of 28.4 if the receipt of loan is not in the business, the SSE is not in the business of providing loans. So this Chetan Chemical judgment is yet to be tested post the amendment, but that is something which we can keep in mind. Coming to Finance Bill 25, the amendment for evergreening of losses. So earlier it was 8 years, fresh 8 years were given whenever there was any merger. Now it has been restricted to 8 years from the year in which the loss was originated. So all these things combined has had a very far-reaching impact on the distressed asset acquisition. So there were reports which were published and which have, has told that because of this, the economic viability of the projects have undergone a lot of reduction. The valuation has come down by 15 to 25%. Because of the tax impact, the cash flow, 20 to 25% of the cash flow has increased now. So again, there's a issue with the future profits also. So what is a way out? So a lot of people have now suggested that we can go for alternative structures, like maybe slum sale would be preferred as compared to share acquisition of distressed assets. So obviously both these provisions have impacted the NCLT purchases, specifically for our clients which are buying the units under NCLT. Earlier, these kind of loan waivers were allowed, but now we have to be very careful. They would be taxable. So we expect that the government should come up with some carve-outs, but as of now, there is no specific carve-out for the IBC companies. Thank you.
Serial number 8, I request, in continuation of that, Ashish Agarwal and Rajiv Bansal, I request all of to at least underline certain areas. Let us read closer, and automatically we'll get the answer based on the of Honorable Supreme Court. SS is a company incorporated under Companies Act. It had filed returns regularly and done so for the assessment year 13-14. I request to underline assessment year 13-14. Now, assessing officer issued notice dated 1st June 21. That also you underline. Under old regime, section 148, on the basis that he has reason to believe that certain income had escaped assessment. Now, this notice, Supreme Court already said in Aseem Thakkar, is deemed to be a notice under 148A clause B. It's a deemed notice now, under new legislature. Now, in compliance of the Ashish Agrawal, AO issued another notice. Now you see that date is 30th May 2022, because Ashish Agarwal came on 4th May 22. Within 30 days, AO has to supply the underlying material. So AO had supplied underlying material for the notice. Now, SSC company was called upon to furnish a response within a period of 2 weeks as per the direction of Supreme Court. And that date also I request you to underline. It is 30th June 2022. And company also filed response exactly on that date. And thereafter, new 148 notice after passing order under clause D of 148A issued on 30th July 2022. Whether this notice is valid, now we need to see. First part we understood. It's a deemed notice, Ashish Agarwal case, that has to come within 30 days of 4th May that you had done. Then 2 weeks time should be given, that also you had given. And we replied on 30th June 2022. Now, role of Rajiv Bansal takes place. What Rajiv Bansal says, we have to see limitation period. It falls between 20th March 20 to 31st March 21. Now, we are referring which AY? You already done underline. Which AY? 13-14. Now, we have specific proviso, first proviso to 149, which clearly says that though new or substituted law was giving permission to reopen up to 10 years, but if under old law it is 6 years, then so far as assessment year 21, 22 and prior to that assessment year, it cannot be extended up to 10 years. It will be up to 6 years only. So if we take it 13-14, then 6 years exactly ends on which date? End of the assessment year. The end of the assessment is 31st March 14. In that you add 6 years. That is 31st March 2020. Therefore, Supreme Court says if action falls between 20th March 20 to 31st March 21, then TOLA will apply and notices can be issued up to 30th June 21. So here our notice is issued on which day? First notice, 1st June 21. So notice is valid first of all. Notice is valid as per Rajiv Bansal discussion. Now Rajiv Bansal says from 1st June 21, we have got Ashish Agarwal's case is there. Therefore there is a deemed stay. Deemed stay up to which date? Deemed stay up to the date when SSC respond the notice. That is which date? 13 June 2022, there is a deemed stay. After that, now AO will have a time to pass the order. Now, how that time is to be determined? So what was the original notice date? 1st June 21. What was the last date under TOLA? 30th June 21. So what are the number of days in between left? Number of days in between left is, it is 29 days. 1st June 21 to 30th June 21. The 29 days assessing officer will get. From which day? When SSC submits his response. So SSC submitted response on 30th June 22. In that you have to add 29 days, and that 29 days ends on 12th July 22. Therefore, AO has to complete the action by 12th July 22. But in our case, you see, last line of the poser, that AO completed action on 30th, and therefore the notice is time barred. So, simple calculation is what you have to do: original notice till 31st June 21, that difference period, you have to add after SSC respond new notice as per Ashish Agarwal, and then you have to check it out whether AO had completed action within that time or not. Clear? Thank you. I'm sorry. I request this citation, you need to note down this on. Extremely sorry. Yes. Ram Balram Build Home Private Limited. I request to note down, this is post Rajiv Bansal judgment. 122 CCH. I repeat, 122 CCH 38 Delhi High Court. Ram Balram Build Home Private Limited. 122 CCH 38. Thank you.
The company had bought back 2,000 equity shares at rupees 100 per share on 13/10/2024. The AO has worked out the fair market value as per Rule 11U and 11U at rupees 200. He proposes to make an addition of rupees 2 lakh under section 56(2)(10) on the ground that the buyback has been at less than the fair market value determined. Now, before we proceed to address this query, please let us understand what the provisions of section 56(2)(10) are. What they say is now in 56(2)(10) that if you get any movable or an immovable property, and where your purchase consideration and the fair market value, if you have not paid any purchase consideration but the fair market value is in excess of 50,000, if you have paid a purchase consideration, then that purchase consideration and the fair market value, if it exceeds 50,000, then that will be your deemed income. Now, they have again given different aspects that in case of an immovable property, how will you value it? So they say that you will go to the stamp duty valuation. In case of a movable property, they say that fair market value will be determined as per the explanation which had been given in section 56(2)(7). Now, what is 56(2)(7) with regards fair market value of an immovable property comprising of shares saying 11U and 11UA? This will be the fair market value determined. Now, in light of this, the issue is that whether 200 rupees is the fair market value and the buyback is at 100 rupees. So there is a difference where you are buying back, you are getting an advantage of rupees 100, which the AO wants to propose, and he is proposing to tax that as income from other sources. Whether the action is valid or not, now we'll come to simple thing. That if you have to buy any asset, then what has to be the position? It has to come to your, if you are acquiring a property, on the asset side it will be reflected. In a buyback, what happens is that there is a reduction of your share capital. There is no acquisition of an asset as such. Now, if there is no asset which you are acquiring, then the question of 56(2)(10) itself would not come into play. So if there is a buyback, there is no new asset which comes to you. For instance, even if you look at it slightly differently, if you are acquiring any property, whether it is movable or immovable, there is a stamp duty involved. Even if you buy shares, stamp duty payments have to be made. In case of a buyback, there is no stamp duty also which is required to be paid, which can be one more argument which can be extended that no, this is not a purchase and I do not get anything. If the company is purchasing shares of somebody else, then that would become an asset. But you are purchasing your own shares. Your left hand is giving something to your right hand. So that would not create any asset. And if that be so the position, there would be no 56(2)(10) coming into play. And there are 4 decisions to this effect. Globe Capital Market, 156 Taxman 620 Delhi. Venture Lighting India, 150 Taxman 523 Chennai. VITP Private Limited, 143 Taxman 304 Hyderabad. And Vora Financial Services, 96 Taxman.com 88 Mumbai. All of these decisions lay down the proposition that where shares you are, there is an effective reduction of capital which is not resulting into any acquisition of any property and therefore would not be subject to 56 to 10. 156 Taxman.com 620. 150 Taxman.com 523. 143 Taxman.com 304. And 96 Taxman.com 88.
Now I take up question number 10. The question is the SSC filed the application for the certificate for TDS at nil rate. The AO denied to grant the certificate of TDS at nil rate or even low rate of the tax on the ground that the SSC has not filed the ITR for the preceding 4 years. Whether the AO is justified for rejection of application. This is the precise query. This is the query related to TDS at the lower rate or the nil rate. The relevant provisions are under section 197. Section 197 subsection 1 provides that the AO has to be satisfied objectively that the total income of the recipient justifies either deduction at a rate lower rate than the rates mentioned in the Act or that no deduction is necessary. Now, what is the inference or view taken by the AO to reject the application? That the SSE, the recipient SSE or the applicant has not filed the return of income for the preceding 4 years and therefore I am not going to grant you the certificate for the lower rate or the nil rate. Now, we have to see the relevant rule 28AA. These are the rules should be read with section 197(1). The title of the rule is Certificate of Deduction at Lower Rates or No Deduction of Tax from Income Other than Dividends. Sub Rule 1, where the assessing officer on an application made by a person under Sub Rule 1 of Rule 28 is satisfied that existing or estimated tax liability of a person justifies the deduction. If you read sub-rule 2 and 3, there is no mandatory requirement under the rule, neither under the relevant provisions of the Act that the SSE applicant should file the returns for the preceding 4 years so that the AO can grant the certificate of lower rate or nil rate for TDS purposes. Therefore, in my opinion, the inference taken by the AO to reject the application is beyond its jurisdiction and against the relevant provisions under section 197(1) read with rule 28AA. If there is no existing tax liability, neither any estimated tax liabilities on the basis of the estimated income provided by the applicant to the jurisdictional AO before whom he has filed the application for lower rate or the no deduction, then there is no jurisdiction with the AO to reject the application merely on the ground that for the preceding 4 years the returns are not filed. You can record the citation, the relevant judgment on this issue. Bitkuber Investments Private Limited versus Deputy CIT TDS 464 ITR 193, Karnataka High Court. In this case, it has been held that there is no mandatory requirement to file the return of income of the preceding years. And there is no jurisdiction with the AO TDS to reject the application on the ground that the returns are not filed. He has to take the view on the basis of the materials or the documents filed with the application whether there is an existing or estimated tax liability or not. And if there is no tax liability, then certificate has to be granted to the recipient. 464 ITR 193.
Question number 11. Friends, this is a very burning and debatable issue going on these days regarding charitable trusts and registration under Section 12AB of the Act. Question is that a trust had sought registration under Section 12AB of the Act, and CIT is proposing to reject on the ground that the trust is pending on only for the benefit of a particular community or caste, and hence it is not eligible for 12AB. Now friends, at the outset I must point out over here that the entire scheme of registration under 12A, 12AA, 12AB has undergone a sea change with effect from 2020, 21, certain amendments in 22, and one such amendment has been made in Section 12AB by introducing subsection 4. 12AB subsection 4 has been introduced with effect from 1st April 2022, which says that if after granting registration or provisional registration, if the commissioner finds that the trust or institution has applied any part of its income from the property held under a trust for a private religious purposes which does not ensure for the benefit of the public at large, or the trust or institution established for charitable purpose, created or established after the commencement of this Act, has applied any part of its income for the benefit of any particular religious community or caste. So friends, here they say that this they have treated as specified violation. They have defined that what is specified violation, and they say that if there is such specified violation, then the commissioner has the right to cancel the registration granted or the provisional registration. Now friends, that is why these days we come across many cases where such type of trust which are created for a particular caste or religion, for a particular caste, and all the clauses in the trust deed are for the benefit of that particular caste, then it is liable to be cancelled in view of this specified violation now defined in the Act with effect from 1/4/22. But friends, fortunately we have judgments which say that this is applicable only with effect from 1/4/22 and not earlier years, because this has been brought specifically with effect from 1/4/22. For that we have a couple of judgments which I would like to point out over here, that this is not retrospective. This is 172 taxman.com, page 316, Pune Tribunal, in the case of M.M. Patel Charitable Trust, and also 168 taxman.com, page 90, Jaipur Tribunal. But friends, as far as benefit of a particular community is concerned, unfortunately we have a very recent judgment of our own tribunal against the SSE, where they have threadbare analyzed this 12AB, subsection 4, what is specified violation, etc. And they have said that since that particular trust was created for the benefit of a particular caste, it is not eligible for 12AB. And this decision is reported in 2025, 170 taxman.com, page 590. The name of the trust is Shri Saudharma Brihad Tapogach Jain, so and so, it's a long name. 170 taxman.com, page 590. Reject करो. 168 नहीं, 170. 170 taxman.com, page 590. There is no criteria, because the definition says that where the trust or institution established for charitable purpose created or established after the commencement of this act has applied any part of its income. It says any part of its income for the benefit of so and so. No, but still, see, that is why I said that it is highly debatable. There is no proportion. It says that any part. So even if it is, say, 10% also, then you are liable to lose your exemption, you lose your registration. If we go by the literal meaning of this violation, this specified violation. So my advice would be that it is better to amend the trust deed, to amend the objects, and to make sure that your objects are, for the benefit of public at large. That would perhaps be helpful. Rana caste, yes. Rana caste I was about to cite, that Rana caste can be helpful to us. That is 82 ITR. Page 704. And also there is one another Andhra Pradesh High Court judgment in the case of Andhra Pradesh Police Welfare, 148 ITR, page 287. This Rana caste says that benefiting a section of the public is also benefit to the public at large. It is not necessary that each and every individual should benefit. Yes. Supreme Court judgment, 82 ITR, page 704. And when this was cited, fortunately our own tribunal, Ahmedabad tribunal itself, has restored the matter to the CIT appeal to the CIT exemption for fresh consideration of 12AB matter in one such matter of Patidar Trust, which I will give the ITA number. Patidar Samaj Trust, which is ITA number 1919/2024, wherein Rana caste has been considered, and apart from that, other 2 or 3 judgments of the Ahmedabad tribunal are considered, and to consider in that line, the tribunal has set aside to the CIT exemption. Tax bill there will be a lot of changes, you never know.
7 series માં જોઈશું.
There's a question. So the next question which has been given to me is, with the rapid advancement of artificial intelligence and automation tools, tax professionals now have to access the AI-driven research, drafting and case law analysis tools. How do you see AI transforming tax advisory, compliance and litigation strategy? So something on the AI, I think before I start on to my answer, I think I just want to ask all of you, how many of you use ChatGPT, Claude, Perplexity or any other chat software for direct tax analysis or case laws? We can have a raise of hands, please. Even ChatGPT is used, yes. So there are quite a few people who are using this. Now, since it is AI-driven question, I just want to also highlight one very important fact now. In December 2024, ITAT Bangalore had issued an order, and in that there were 3 Supreme Court judgments and 1 Madras High Court judgment which did not even exist. And the order was later on recalled, citing inadvertent errors. So the point here is that while we are very happy to get all the things on our records, we should also see the veracity of it, because this was a live case where the artificial intelligence basically gave them a wrong judgment. The judgments did not exist. One more case had happened where they had given us a judgment which had the totally different facts from what it was originally given. So again, even though the citation is right, the facts were wrong. So all these things are the drawbacks of AI that we would like to highlight. But yes, the question was asked on the 3 points. One is on the tax advisory, compliance and litigation strategy. So on the on the research first, of course, AI will help a lot of us. So while we use ChatGPT, there are other also cloud AI software available, like you can use Cloud, you can use Perplexity, which are very good for research. And they are very useful, because if you can, let's say, upload a document of more than 200-300 pages, you can upload a PDF, you can give a good prompt that please summarize this PDF in 5 pages. They will summarize that PDF for you. So all these things can be used, when we talk about using the AI to our advantage. They are very good at analyzing patterns, and basically they can draw draw important information very quickly. They can also give personalized client advisory. So you can give prompts that my client is in so and so sector. Kindly give me some guidance on what are the factors which to be considered. So he will give you a right guidance. But again, as it is said that only AI is not sufficient. AI along with HI, that is human intelligence, our own judgment is also very, very important. Now coming to tax compliance, I think as we all know now, because of AI, tax compliance definitely is going to be much faster. I think 80-85% of the work will be done by AI. So we have to, somewhere as a professionals, we'll have to adopt that technology also. The biggest advantage that they have is routine, mundane tasks can be done very fast. So we have to adopt with that. And of course, they are very good at compliance and very good at identifying errors, which we should take into benefit. Coming to litigation side, yes, drafting. We can use ChatGPT, Claude, or even other softwares for drafting, where you can, of course, they will not be drafting the way our experts here on the dais will be drafting, but they can help us with a lot of drafting things, so we can use that for the drafting. Second, they can also give us a lot of analysis of the cases. Again, the cases quoted might be wrong, but they can give us a trend of what is happening. So few challenges that I see when I talk about AI and profession, and especially with the direct tax advisory. One is the data privacy and security. When we upload our client's data, it goes into the cloud, but we don't know whether that will be used. That is basically open source. It can be used anywhere. So data security is a big concern. Second is on the ethical and professional challenges. We normally certify whatever we get information from the AI, any tools, and we certify, but we have to check for the accuracy of it, because we'll be professionally liable for it. And the biggest issue that I face is the hallucination, which is normal. I just told you about, see, these are all generative AIs. So how you train them, they will give you reply. So I came across a classic WhatsApp message which said that, I just put a message on ChatGPT that I am having this income tax problem, kindly help me with the case laws. So ChatGPT gave me 500 case laws, 300 were in favor of SSC, 150 were in favor of department, and 50 were self-generated. They told that this looks legitimate, but they do not exist. So we have to be very careful when we or our audit team is drafting, or maybe doing some using the ChatGPT. Very important for us to take into account these factors. So I will just close by this, that of course it's a big enabler. It's a very important tool, but we have to use with our own human intelligence. Thank you.
Serial number 13. Again, I request pen, pencil you have. This issue pertains to assessment year 15-16. Now this is, earlier was 13-14 we have dealt with. Now this is 15-16. And these are all cases at appellate. First appeal they are pending mostly. Even some travel to even tribunal also recently. Now return was filed on 4th November 2015, declared nil income. On 30th June 21, notice under 148 was issued. That is old regime. That income had escaped assessment, reason to, on the basis of reason to believe. After decision of Supreme Court, in Ashish Agarwal, second round started, and 148 AB was issued on 30th May 2022. Response was filed on 11th June, demanding certain documents. Additional objection also filed on 14th June 2022. And finally, notice under 148, along with order under 148 AD, was given on 26th July 2022, whether this notice is valid or not. If we read Rajiv Bansal, Part C, it's a very lengthy judgment, where submission by the income tax department, submission by the revenue has been given, detailed submission, where revenue itself had given a table, where this is 15-16 AY. Now, if we look at first proviso to 149, which says that assessment year 21-22 and prior to that, under old law, time limit is 6 years. So 15-16 ends on 31st March 16. In that you add 6 years. Then action falls for completion by 31st March 22, practically. Therefore, it is not falling between that TOLA time. Therefore, revenue itself said that 1516, any notice issued after 6 years, that is after 31st March 22, which is bad in law. River itself admitted before the Supreme Court. And this matter again came up specifically for this issue before the Supreme Court in case of, you note down the citation. It is RK Build Creations Private Limited, 122 CCH 132, where Supreme Court simply in para 2 clearly said that in Rajiv Bansal, department itself admitted and given a concession that 6 years have already passed, and therefore this notice is invalid. The final conclusion is notice is invalid. Citation and request to note down 122 CCH 132 RK Build Creation Private Limited. Thank you. One 22 CCH 132. You can also note down another two. One is Delhi High Court after Rajiv Bansal. It is 170 taxman.com 506. Rohit Kumar, 170 taxman.com 506. And one more is after Rajiv Bansal, Mumbai Tribunal, 171 taxman.com 388. They all are for AY 1516. 171 taxman.com 388.
Question number 14. A search has taken place on 28th March 2021, and during the course of search, a letter was found from SEBI which indicated that prices of certain scripts were rigged. The SSE, while completing had filed the return of income declaring his normal capital gain, and while completing the assessment under section 153A, additions have come to be made that this rigged enhanced value price is effectively cash credits. It is your introduction of your own money, and this is not capital gain, and therefore exemption under section 1038 has come to be withdrawn. As you are well aware, that in case of a search, only on the basis of, there are two again sectors once a search takes place. That is, for 153A proceedings, you have to bifurcate. One set of years would be where your assessments have been completed. Those assessments will not abate, which are called unabated assessments. And one where the period for issuing notice would be still alive. So those assessments where those years where the assessments have not been completed, only those would abate. In case of where the assessments abate, the AO can take into consideration any information which has been found during your return while making his inquiry post search, and also the incriminating material if it has been found for that particular year. But the question is here, let us presume that this is for a completed assessment year which has not unabated. Whether any incriminating material has been found, because which would allow and permit and authorize the AO to make such additions in 153A proceedings. In this case, what would be an incriminating material basically is that it must have some indication of an undisclosed transaction or an activity which is not reflected in your books of accounts or your return of income. That is how broadly you can define what an incriminating material is. The Supreme Court in the case of Abhisar Buildwell Private Limited, 454 ITR 212 Supreme Court has clearly laid down that where in respect of a completed assessment, unabated assessment, no addition can be made by the AO in absence of any incriminating material found during the course of search or during the course of requisition. Now in this case, what is the incriminating material? It says that there is a letter from SEBI. That letter of SEBI says what? That these shares are rigged. Now this is just a warning letter issued by SEBI to all investors. I happen to be an investor in that shares, but that is a general letter. It is not a confidential letter. It is not something which is alleging that I have made any rigging. I am a part of it. So therefore, this is a general communication which has been found. This I have received and I have kept it in my file for my record purposes, but by itself it is not incriminating. During the course of search, whether any such material has been found by the basis of which we can draw an inference that yes, I have manipulated the share prices, I have inflated the sale consideration and introduced the own money back into my books as capital gain, which otherwise should be taxed as unexplained cash credit is under section 68? No. There is no such information as is available from this question that any incriminating material has been found. So therefore the answer would be that no, this addition, if it has been made purely under section 153A on the ground that there is no incriminating material, no additions can be made. Now let's go one step further. Suppose a search has taken place, and in that search, the director himself has admitted that I have rigged the capital gain prices, I am involved where I have taken inflated money and this has been done. That director has said, and that director's wife's return has been filed. However, she files the return at a normal income. She discloses nothing about, though there is an admission of the husband during the course of search proceedings. Whether that statement by itself would also constitute incriminating material? No. It will, on a standalone basis, a statement by itself without any corroborative evidence would not constitute an incriminating material. Because during the course of search proceedings, nothing has been found that cash has been going out, it is coming back in form of checks. So even in such a case, even though there is an admission by the husband of the SSE, no such adverse inference can be drawn. Kavita Agarwal, 143 taxman.com, 404 Delhi. Parallel citation is 457 ITR 112. So the golden rule is that there has to be some incriminating material. By itself, a statement cannot be the reason to visit me with addition in a complete, where the assessment is a completed assessment in 153A proceedings.
Next question. The tax recovery officer adjusted the amount of refund in excess of 20% of the total disputed tax demand. Whether such action is within the jurisdiction available to the TRO. Presuming that the SSE concerned has filed the appeal before the CIT appeals or before the ITAT. We have to first presume, because the jurisdiction is, as per the query, is with TRO. So the SSE is facing the recovery proceedings. And during the recovery proceedings, he has adjusted or recovered the amount more than 20% of the disputed tax demand. If the SSE has filed the appeal before the first appellate authority or before the ITAT, as per the provisions of the law, even if you read section 253, 20% of the total disputed demand is required to be paid so that the SSE concern cannot be treated as the defaulter in the area of law. Section 245 is also very much relevant. If the SSE has filed the appeal challenging the issue, raising the demand of tax arising out of the assessment order, and 20% is already recovered, and the refund is still there in the hands of the SSE, before making any adjustment, the provisions of section 245 requires the intimation should be given to the SSE before making any adjustment of the refund, so that to prevail the rule of principles of natural justice. Because if there is the recovery of 20% of the total disputed demand, and even then the SSE is entitled to refund, and the TRO is very much strict or deterrent for the recovery, it is the requirement under section 245 also. That apart, we have the board instruction number 1914 dated 2nd December 1993. The office memorandum dated 29/2/2016 also gives instructions to the jurisdictional level, including the TRO. All these instructions are binding upon the jurisdictional officers of the department. The instruction, which is the integral part of the old one instruction dated 2nd December 1993, instruction number 1914, which was earlierly extended on 29 February 2016, which gives instruction for the recovery of the 15% of the total dispute demand. Then in 2017, Office Memorandum dated 31st July 2017, 5% has been increased. So now, in the cases of demand arising out of any order by the officer, the 20% is paid, the SSC is not going to be treated as the defaulter in the eyes of law. Stay has to be granted. In the query, it is stated that the TRO has recovered more than 20% of the total disputed demand. In my opinion, he has no jurisdiction, he has no powers. The action of the TRO to adjust the refund in excess of 20% of the total demand, it is purely in violation of the Office Memorandum and the CBDT instruction number 1914. The citation you may note down. One judgment I find out, Ramesh Construction Private Limited versus Deputy CIT, 442 ITR 181, Delhi High Court. There are so many judgments now. The tax authorities have no powers to recover more than 20% if the SSC has filed the appeal before the appellate forum. Condition is that in the Office Memorandum, appeal must be filed by the SSC. If not filed in time or not filed, he can recover 100%.
I'm taking up question number 16. It is basically regarding penalty under section 270 capital A of the Act regarding underreporting of income or misreporting of income. The question here is that the SSC was an employee of telecom department, got voluntary retirement, and it had claimed exemption under section 1010AA, which was partly allowed and partly disallowed. The disallowed part is accepted by the SSC, and on that disallowance, penalty is sought to be levied under section 270 capital A subsection 9 for misreporting of income at 200% of the tax. Now clearly in these circumstances, the action of the department is not justified. We have got now a plethora of case law. First of all, now the case law says that just like 271(1)(c), we used to have that whether it is for concealment of income or for furnishing of inaccurate particulars of income. Now for 270A also, see for underreporting of income, there are clause A, B, C, D. Then for under section 270A subsection 9, they have defined as to what is misreporting of income by 6 instances, A, B, C, D, E, F. So now the case law says that at the time of initiation of the penalty, in the notice itself, the specific limb of the specific default should be mentioned. That if it is for misreporting of income, then you are caught under clause A, B, C, whatever. Or if it is for underreporting of income, then they have to specify the limb. If the specified limb is not reproduced in the notice itself, then the entire penalty order is liable to be quashed. For this, we have 2 or 3 good judgments. We have Pune Tribunal in 171 taxman.com, page 133, and Mumbai Tribunal in 170 taxman.com, page 792. Friends, what we can take help is 270A subsection 6, because subsection 6 says that the case will not fall under reporting of income if you offer an explanation regarding a disallowance and that explanation, you satisfy to the department that you have disclosed all your facts relating to that particular item. It says, subsection 6 says that the underreported income for the purpose of this section shall not include the amount of income in respect of which the SSC offers an explanation, and he also proves that the explanation is bona fide and has disclosed all the relevant facts to the department. If this is so, then it cannot be a case of underreporting of income. And friends, so we can take aid of all the judgments regarding 271(1)(c) also, regarding bona fide belief, Hindustan Steel, or regarding full and true disclosure, Reliance Petro product, then National Textiles, Dilip Shop, etc. All those milestone judgments of 271(1)(c) can be equally applied to this penalty also. And friends, I am happy to share one very recent judgment of our tribunal, Ahmedabad Tribunal, which has laid down very beautiful principles as far as this penalty is concerned, which is in the case of Parul Ben Vijay Kumar Patel, 163taxman.com, page 191. 163taxman.com, page 191. Friends, interestingly, in this case, the SSE had not filed the return of income, even though there was a large capital gain. He had sold the property, there was capital gain, but he had not filed the return of income. Now, when he received 148 notice, he filed the return, paid the taxes, did everything. Now, when it came to penalty for misreporting of income, for misreporting at 200%, it was argued by the SSE that I was not having any other source of income, and as far as sale of immovable property is concerned, the TDS was done by the purchaser, and that TDS was reflected in the 26 AS, which is on record of the department. So, I could not have hoped to conceal something which is already on record of the department. The TDS is done. I was under the bona fide belief that since TDS is done, I was not required to file any further return of income. Tax has been deducted, reporting has been done under 26 AS, so department knows everything. And friends, fortunately for the SSE, this argument came to be accepted by the tribunal, that yes, this is a genuine bona fide belief, and I cannot hope to conceal something which is already on record of the department. And since he did not have any other source of income, and TDS was done, and only some minor tax was required further to be paid, it could not be held to be a case of misreporting of income.
The next question given to me is, what verification and reporting approach should tax auditors adopt for disallowance under 43BH for late payment of micro and small enterprise dues? So I think 43BH was amended by Finance Act 23 to include any payments that that SSE is supposed to pay to the micro and small enterprises. And we know that the micro and small enterprises are normally manufacturing and service sector enterprises and not the trading ones which are covered here. I am going to refer here to the technical guide which has been published by ICI in 2024. They have given a very good description of what is the auditor's responsibility, what is how to do the verification, how to do the documentation, and of course how to do on the reporting side. So the key aspects that they have mentioned is, first, to identify the MSME vendors. I think we all are in the month of March now. A big challenge for all of us is first to tell our accountants and the audit team of the client to identify all the MSME vendors, make sure who are micro or small, arrange for the certificates, because it is all based on the Udyam Aadhar. So we have to get all the Udyam Aadhar in place. If we don't have Udyam Aadhar, then we will have to say that they are non-MSME. So that is first important thing. Second, to see the agreement. Now we always assume that the payment is 45 days. Only then it is overdue. But that is only if there is an agreement. If we don't have an agreement, then the payment deadline is only 15 days. So we have to make sure that all the vendors which are classified as MSME, the agreement is there or not. That again has to be checked at our level. Third is on the payment analysis. We also have to make an aging of all our creditors which are MSME to see whether how many of the payments are outstanding for more than 45 days. Now, since we are in the month of March and March end is approaching, we have to make sure that all the payments which are, basically from the April month till today which are due now has to be paid by 31st of March. And of course, if the bills are in the month of February, March which are due after that, that can be paid at the time they are due. But at least we have to make sure that all the payments are done before the March end. Now they have also, in the technical guide of ICI, they have also given us how to report under clause 22, because the tax audit report under clause 22 mentions about the interest to the MSME and also mentions about the disallowance under 43BH. So they have given a detailed annexure. It is worthwhile to refer to that we have to prepare a comprehensive annexure containing a vendor-wise listing of all MSME vendors, date of supply for each transaction, due date as per the MSME Act, actual payment date, and the amount disallowable. And they also recommend us to prepare a reconciliation with the MSME details as shown in the audited financial statements vis-a-vis the audited MSME as per the disallowances that we will be reporting in the tax audit report. Another very important point that we have to consider in the MRL. we normally give a management representation letter for our stat audits, but even important for us to give MRL for the tax audits, and especially for 43BH reporting, because it is again the responsibility of the client to give the accurate information. And if we are not available with the correct facts, then of course the technical guide also tells us to qualify the audit report accordingly. Thank you.
In this case, notice under section 148 has been issued in a case of Mr. D for assessment year 2016-17. Subsequently, a search took place in the case of XYZ, and on the basis of the statements recorded of the accountant and directors of XYZ, they implicated that D had undertaken unaccounted transactions with them, and therefore notice under section 153C to D had come to be issued. Now, whether parallel proceedings under 148 and 153C can continue, that is the first issue. What if they have closed down 148 proceedings and thereby 153 subsequently C proceedings have come to be declared as illegal? Then what would be the fate of those 148 proceedings if they have come to be dropped? As I have pointed out earlier, that in case of completed assessments, if there is no notice pending, then those assessments, they are closed, and only if there is incriminating material to that extent, those closed assessments, completed assessments, unabated assessments, they would survive to that limited extent. Which are not abated, which have abated and which were alive at that point of time, yes, all this information plus regular information can be taken on record. Now, in this case, probably only on the basis of the statement and no incriminating material, these proceedings of 153C have come to be initiated, and that SSC must have definitely taken advantage of Abhisar Buildwell, which I just recently quoted, that only if there is incriminating material, merely statements of any person by itself without any corroborative material to indicate that I have entered into any unaccounted transactions would not be sufficient for me to be visited with 153C proceedings, and therefore those might have been dropped. In that case, what would happen? My 148 has already been closed by them earlier. They have visited me with a 153C proceeding. Now my 153C proceedings after some time has become again illegal. So whether that 148 will again spring into being active or that is closed forever. On a personal level, I think that if the time limit again for 148 has gone off, but that is my personal view, then now it cannot be revived. That is what even Abhisar in that reservation states. But however, Chennai High Court has dealt with a situation, and Chennai High Court in the case of GRT Jewellers India Private Limited, 161 taxman.com 117 has taken a view that where proceedings initiated against the SSE under section 148 would have abated upon issuance of notice under section 153C if there was incriminating material for relevant assessment year. However, since there was no such material, proceedings under 148 were not deemed to have been abated. They said that no, this will never abate only. Therefore, the impugned order passed under 143.3 read with 153C was to be quashed, and reassessment proceedings initiated under section 148 were to be completed in accordance with law, where you will exclude the time between initiation of proceedings under section 153C and receipt of the court's order, because that court has finally decided in this case that this is an illegal proceeding under section 153C. But on a normal reading, what happens is that only appeals, if they have been annulled further in 153A, they stand to be revived if they have been annulled. But assessments, if a 148 notice has been issued, then that, according to me, it should be, it has to be closed down and it cannot be revived unless there is, but if any of my friends here have a different view, revival, appeal, it's not for assessment. But this is right now the only decision which says that no, 148 will again resurface and 153C if it has been held to be illegal.
I'm coming to serial number 18. Serial number 18. Taxpayer is a private limited company. Again, I request you to pay attention to assessment year. All these are cases almost your clients are facing in your NLE. Assessment year 17-18. Here, again, there was some information. SSC company had obtained accommodation entry for bogus bill amounting to some 7 crore, and notice was issued under 148 on 22nd 4/2021. Again, Ashish Agrawal. The said notice became deemed notice later on, pursuant to direction of Honorable Supreme Court in Ashish Agrawal. To comply with this direction, notice under 148A(b) was issued on 20th May 2022. And finally, D order was passed on 30th July 2022 by not accepting the claim of SSC. And order under clause D was passed that it is a fit case for issuing notice under 148. But last line is very important. I request all of you to underline that while issuing this new notice under 148, approval was taken from PCIT 6 Mumbai. And the question is whether this notice is valid or not. Now I request first of all to recapitulate section 151. Any notice or any order passed under clause D of 148A, it has to be after obtaining prior approval of a specified authority. And specified authority for relevant point of time for this notice, it has again been degraded after 1st October 2024. By that time, specified authority is like this. If assessment is going to be reopened up to 3 assessment years from the end of relevant AY, then it is principal commissioner, principal director, commissioner or director. And if it is beyond 3 years, up to 10 years, then it is principal chief commissioner, principal director general. And if this principal chief commissioner or director general is not there, then chief commissioner. If it is beyond 3 years, up to 10 assessment year. Now, I request here, if you are having this specific issue of AY 17-18, across India, department had committed error in obtaining appropriate sanction. In Rajiv Bansal, Supreme Court category made clear that any notice, if it is not in accordance with the sanction, it has to be put down. Completely it should be quashed. And Supreme Court had given example of AY 17-18 in its order itself. This case, AY 17-18, Supreme Court said that in this case, if you see 17-18, now time limit is 3 years from the end of assessment year. That comes to an end on 31st March 2021. Therefore, TOLA applies. Supreme Court says TOLA applies. Therefore, approval extension is also possible up to 30th June 21 under clause 1. Under clause 1, up to which date? 30th June 21 under clause 1 of 151. That means PCIT can grant approval up to 30th June 21. Up to 30th June 21. After 30th June 21 notice is issued, then it is beyond 3 years, then approval has to come from whom? Principal Chief Commissioner, Principal Director General. That Supreme Court categorically mentioned with the example. And therefore this matter is covered by Rajiv Bansal number 1. And following Rajiv Bansal, we have got Mumbai Tribunal on this. I request you to note down citation 169 taxman.com 736. I repeat 169 taxman.com 736 Surya Ferrois Alloys Private Limited. I'll tell you all 17-18 they committed this error because they followed instruction number 1 2022. And instruction number 1 2022 they failed to take care of this approval aspect. So I request that you can take advantage of Rajiv Bansal itself and plus this. Thank you.
Now, question number 20. Addition made purely on the basis of the statement of third party, invocation of section 68, read section 133A of the Act, no cross-examination permitted. The query suggests that 133A, that is the survey, some action on the deemed provisions of section 68 based on the statement of the third party, but no cross-examination permitted to the SSC concerned. It is a very settled proposition of law that any material or statement of any person relied upon by the assessing officer, the material or the statement of the third person should first be provided for the cross-examination or cross-verification of the material of or that person. In this case, no opportunity of cross-examination of that person whose statement has been recorded at the back of the SSE. It is the pure, patently in violation of the principles of natural justice. So many judgments. I only quote one judgment, Andaman Timber Industries versus CCE, 38 GSTR 117, Supreme Court. There are so many judgments, but this is a landmark judgment which covers the solution to the query raised by the querist. Simple. He has no power to straight away rely upon the statement of any person which has been recorded at the back of the SSC.
What is this?
Question number 21, it falls in two parts. The first is that if in case of sale of immovable property, amount is received by way of advance or earnest money, and that is invested to claim deduction under section 54 or 54F or 54 EC beyond the specified period, then whether deduction is allowable or not. Friends, here the question is that whether that time limit is sacrosanct or it is director in nature, or we have to see the essence of transaction, that the money received on sale of immovable property is parked in another immovable property or for purchase of bonds. Now friends, the decided case law is in favor of the SSE. For example, 54F says that I can purchase the property 1 year before the date of transfer. Now, if I have invested even prior to 1 year, if I have received advance money or earnest money prior to 1 year and I have invested, then whether that is liable for deduction or not. Likewise, say in case of investment in bonds, if I have received advance money prior to transfer and I have invested in bonds, because bonds 54 EC says that I have to invest within 6 months from the date of transfer. But here I have done before the date of transfer. Whether that is eligible for deduction, or likewise even beyond 6 months if it is invested, but it is out of the sale consideration, then the decided case law is in favor of the SSE, that yes, because the crux of the matter is that the amount of sale consideration should be invested in purchase of immovable property. For this I will give a couple of case laws only. Bombay High Court in the case of Parveen Bharucha, 28 taxman.com, page 274, which has considered the CBDT circular also, CBDT circular number 359, dated 10th May 83. And likewise, for 54 EC, if it is invested late also, it can be eligible for deduction if it is invested beyond 6 months. That also we have a case law of Karnataka High Court in the case of 87 taxman.com, page 228. Likewise, this situation can be helpful in case of compulsory acquisition of land also. For example, if there is compulsory acquisition of land, whenever there is TP, etc., they acquire the land, but then regarding compensation, there is always a litigation. We have to go in courts, and many times the compensation is received late. And if that late compensation received is invested, then the date of 6 months or the date of 1 year or 2 years is to be counted from the date of receipt of actual compensation and not the handing over of the property. For that also we have a case law of Allahabad High Court in the case of Janardhan Das, 170 taxman, page 113. The second part of the question is that whether this deduction is allowable if the new property is purchased in the name of wife, in the name of spouse of the SSE. Friends, here also the decided case law is in favor of the SSE, that yes, if it is invested in the name, if the sale consideration received is in the account of husband, and that same sale consideration is used for the purchase of property, but only the name of wife is used in the registration, then that deduction is allowable. For that we have case law of Delhi Tribunal, 158 taxman.com, page 265. Friends, here in this case law, a plethora of case law is considered. I will not go into the details, but where they have considered many case law which goes that apart from spouse, if it is in the name of spouse or joint name with the husband or minor daughter or even married widowed daughter, all these are eligible for deduction. But friends, unfortunately, recently we have a case law of Ahmedabad Tribunal wherein I was at the receiving end because I argued that matter. The investment was from sale consideration, but because of certain difficulties, the investment was made, the registered document was made in the brother's name. Now, I tried to argue and applied the analogy of all these judgments, but unfortunately the tribunal said that no, as per Hindu Succession Act, brother does not fall as an automatic legal heir unless it is by way of will or etc. So brother is a separate thing. If the investment is in the name of brother, we will not give you the deduction. So friends, be careful that this is the distinction drawn by our tribunal recently in the case of Jobanji Thakur, ITA number 264, public 2019, dated 26th February 25.
The next question is on section 80JJAA, which provides a significant tax deduction for businesses hiring new employees, making it especially beneficial for labor-intensive industries. However, many taxpayers fail to utilize it fully due to complex conditions and misconceptions. So we'll explain how businesses can strategically structure their hiring to maximize tax benefits and reduce overall tax liability. So again, a very interesting section which most of us fail to take into account. Since we are again in the month of March, a very important tax planning tool for the companies. 80JJAA, as we all know, for the new workmen, the employees, the additional employee cost is given as a deduction. So normally we had a misconception that only factories, or only manufacturing sector can, those employers or those SSEs can only get this benefit. But that's a misconception. There are very simple rules for this section. So there should be a company or a firm, and that should be under tax audit and under section 44AB. That is a simple condition. Then they should have employed new employees in the current year. So there should be increase in the number of employees. The average salary of the employees should be less than 25,000 per month. The employees should be registered under PFESI, and the salary should be paid via banking channel. Only these simple 4 conditions, if they are satisfied, then all the additional employee cost that is borne by the company for that year, 30% of that amount is given as an additional deduction, and that is for 3 consecutive years. So if you consider, let's say a simple example of a company having a turnover of 50 crores around, and they are having additional 50 employees who follow all these conditions, and let's say there are 50 employees and 20,000 is an average salary per employee, though it is around 1.2 or 1 crore amount is an additional employee cost. So considering 30% of that comes to around 36 lakhs per annum. So out of the 36 lakhs per annum, 30% is the tax saving. So it comes around 10 lakhs per annum. So if you consider it for 3 years, it's around 30 lakhs of tax saving for that company. And this is not only available for 1 year. If you increase the employees in the next year, another 3 years are given to you. So it's a cumulative benefit that is given. Again, a very, very good opportunity for us, as a value add that we can give to our clients. And there are a few misconceptions that I would want to highlight. One is, as I mentioned, only manufacturing companies. The answer is no. Even service sector business are also eligible for 80JJAA. Second is whether all the employees should work for 240 days. So again, the answer is no. If the new employees have not worked for 240 days in the current year, if they have worked for more than 240 days in the next year, then they will be considered as an additional employee for the next year. And the third is whether it is available only for 1 year. So again, as I clarified, it is available for 3 years, and that cumulative, every time there's an increase, you will get a cumulative benefit of it. And how we can value add to our clients? Of course, we can help them with the employment planning, when to recruit, And of course, we can help them to structure their salary and also on the documentation, because when we are working for ATJJAA, we have to be very sure for the appointment letters, the leave letters, and all the working in the Excel that we maintain for this. We also have to give a form 10DA. As a CA, we have to certify that. So all these things are very relevant, and we should definitely consider this as a tax planning tool for our clients. Thank you.
Serial number 23. Are the notices issued by jurisdictional assessing officer under 148AB and 148 of the Act after launch of e-assessment of income escaping assessment scheme 2022, notification number 18 2022 dated 29th March 22. Here we know that Faceless era has started, and I think first we had e-assessment scheme 2019, and had an opportunity under the AGFTC banner to travel various places to meet our members and guide them on faceless assessment. And step by step, government had extended that faceless assessment scheme even for 148 proceedings, 147, 148 proceedings. And we have got many judgments in favor of SSC that notice under 148 capital A has to be issued by faceless officer, not by judicial officer. So many judgments journey started with Telangana High Court. We have got Kanakkala, then Venkatraman. Then thereafter we have got Bombay High Court in case of Exaware. That notice has to be issued by faceless, not by the judicial assessing officer for reopening your case. Then we have got Guwahati High Court, Ram Narayan, then Punjab High Court in Jatinder Singh, again Bombay High Court in Kios Property Private Limited. Now, all these judgments and the additional set of arguments from the revenue were considered by Delhi High Court. I request you to note down citation first, and then we'll understand what Delhi High Court ruled out. 341 CTR 465. I repeat, 341 CTR 465. TKS Builder Private Limited. T, K and S. T for Thakkar, K for Kamal, S for Shah. Or TKS Builders Private Limited. 341 CTR 465. Now, few paragraphs are there. I'll just point out relevant aspect. Delhi High Court is not in agreement with this. That notice of 148 capital A has to be issued by faceless officer. They are not in agreement with this after considering the argument, after considering the scheme of the Act, after considering the particular provisions of Section 151A of the Income Tax Act. And para 87, I am reading few lines. Delhi High Court had written that within the framework of faceless assessment system, jurisdictional assessing officer retains power that do not conflict with, but rather complement the object of neutrality and efficiency. Therefore, Delhi High Court clearly said that parallelly, both authorities' power continue. And the jurisdictional assessing officer retains power not in conflict with, but in complement with the faceless officer. Then Delhi High Court further written that Act specifically channels this information to GAO, because we know that when we receive 148A notice, then the information is given to whom? Not to the faceless officer, it is given to whom? Your jurisdictional officer. That is, we call it case related information detail, CIRU they write. So that information is given to whom? Jurisdictional assessing officer. And he knows about your case, because he handles day in, day out about, he has got regular jurisdiction over your case. So the Delhi High Court says, Act specifically channel this information to jurisdictional assessing officer, who is then statutorily responsible for initial proceedings and evaluation of data. Like suppose in Insight portal, the information is given to the officer that this is a non-filer, and these transactions had undertaken, like remittance of foreign exchange had undertaken, and he is a non-filer. Now, who will verify all this? Your jurisdictional officer will verify that whether this fellow is a non-filer or not. The High Court had clearly written that information is channeled to judicial assessing officer. And therefore, para 88 High Court had written further judicial assessing officer power should be understood as integral and not in conflict with the faceless assessment. Rather, it represents a foundational jurisdictional safeguard, enabling judicial officer to initiate reassessment based on independent, credible sources of information. This concurrent authority of judicial officer reinforces integrity, adaptability of faceless system, ensuring that both centralized and judicial assessment operate cohesively within the larger statutory framework. Therefore, they said both can act. Initially, judicial assessing officer, and then High Court further written that matter is then shifted to faceless. And when it is shifted to faceless, High Court written in para 89, it is automated, randomly allocated case. And therefore, transparency is maintained. And finally, High Court referred Gujarat High Court. And that is 3 days before this judgment of Delhi High Court. It is our judgment of Talati and Talati LLP, Gujarat High Court. I have not got citation in this. High Court says that whatever view we have expressed, similar view recently expressed by Gujarat High Court 3 days back. So this is the detailed judgment, and I am in full agreement, because Gujarat High Court in Talati and Talati LLP, they have focused on these important wordings of the 151A. And 151A says faceless has to be done. What is the clause A of 151A1? Eliminating interface between income tax authority and SSC or any other person. Now, word is very important. To the extent technologically feasible. Therefore, section itself says to the extent technologically feasible. Now, this is not, initial level is not technologically feasible because your records are with judicial assessing officer, and that wording has been interpreted by Gujarat High Court. And accordingly, my view is that though there are favorable judgment 5-6, but TKS has ruled out. And matter is, I think, in Supreme Court, and Supreme Court will take a view that both parallelly exist. Initial notice can be by JAO.
A search has taken place in the case of a builder, and during the course of search proceedings, digital data has been retrieved, which indicates that there is charging of on money. On the basis of such incriminating material, 153C proceedings have come to be initiated in the hands of the members who have made the booking, and the AO, on the basis of his name appearing in that digital area, has proposed to make additions as unexplained investments in the hands of the member who has made the booking. Now, coming to this issue that whether all this is completely correct and 153 proceedings are valid, they are validly undertaken, we come to the immediate step that whether such additions can be made under section 69, where in an Excel sheet which has been maintained by the, say, a builder, and that Excel sheet contains what? Name of the member, the date of booking, what is the type of booking which has been made, date of payments, amounts paid in check, amounts paid in cash, total amount, so on and so forth. This might be the Excel sheet content. On the basis of that cash element which has been noted in that Excel sheet, an inference is being drawn that I have made unexplained investments. Now, at this stage, the arguments which can be extended is that firstly, whether digital data which has been recovered in the form of an Excel sheet, whether it would constitute incriminating material. Now, for this particular issue, that whether it doesn't constitute incriminating material, and therefore even 153C proceedings are questioned, Supreme Court, first decision which I would point out is Supreme Court in the case of Common Cause versus Union of India, 394 ITR 220, where they say that where department has no evidence to prove that the entries in the loose papers and electronic data were kept regularly during the course of business of concerned business houses, and therefore these detailed documents recovered by the authorities had no evidentiary value. So they said that if those Excel sheets which contain unaccounted information, they are not a part of your regular record, which books of accounts which you maintain, then they cannot be taken. They have no evidentiary value. This has been very followed by Sunil Kumar Sharma in 448 ITR 485 Karnataka, where loose papers, again diaries and everything was found during the course of search which contained those typed entries. That has not been considered as an incriminating material, and because they are not your part of the regular books of accounts. And most importantly, recently Gujarat High Court in an unreported judgment has also taken, they have taken a very pro-SSE view. Kaushik Nanubhai Majithia, R tax appeal number 20 of 24. I'll just read out the paragraph to what extent they say that Excel sheets maintained in such a manner have no value. We find an inherent fallacy in this submission in as much as there is no basis of conducting proceedings against the SSE merely for the fact that the developer had paid taxes on the amount shown in the Excel sheet. In this case, on the basis of that unaccounted money which was noted in the Excel sheet and which was maintained by the builder, that builder had gone to the settlement commission, and that in that settlement commission he has offered that unaccounted money. Even that, they say that that cannot be the reason, that merely because the builder has accepted that cash element allowed and taken and offered it to tax. There is no adjudication with regard to the payment which was shown in the Excel sheet to the effect that the same was actually paid by the SSE to the developer. Even otherwise, concurrent findings returned by the CIT appeal and ITAT are that the document found from the premises of the third party, namely Excel sheet, which is the basis of proceedings, was without any signature. There is no corroborative material to substantiate the said document. The nature of document has also not been explained by the AO while proceeding against the SSE. The statements of the persons recorded during the search with reference to the alleged seized material was not provided, and hence the entire proceedings under section 153C stood vitiated. So Excel sheet unsigned, it has no value, statements not given. Even if he has offered money as income by the builder has offered, that is also irrelevant, because this has not been considered as incriminating material. In any case, the other argument which can be extended is that there has to be some kind of a corroborative material. That there might be a simple noting, but if that noting by itself is not incriminating material, something more has to be attached. Suppose if I have made a cash payment, then there would be some kind of a receipt, some kind of a PDC, some kind of an acknowledgement that I have received cash from me on this date. If there is some kind of a corroborative evidence, merely because there is a noting in a diary date, anek amount lakhelo in coded form, by that it cannot be treated as an incriminating material. So this corroborative material needs to be taken into consideration, and for that, couple of decisions which I would point out are Nazmeem Jamal, 147 taxman.com, 343 Mumbai, where corroborative material is essential in support of the incriminating material. Harmohinder Kaur, 187 ITD 289. PV Kalyan Sundaram, 294 ITR 49 Supreme Court. And lastly, Santlal, 423 ITR, page 1, Delhi. And further, another argument which can also be taken is that, sir, these documents have been found from the search party. He may write whatever he wants, he may name me, you, anybody. The presumption that these documents would be extended to the person who has been searched, and it cannot be extended to the third party. So that 292C and 132(4) cannot be extended to third parties. This further can be also made as an argument. And following these decisions, Ahmedabad Tribunal, and my learned friend has argued, Kirit Kumar Champaklal Shah, the similar item where builders' Excel sheets have been found, and he has already gone to the settlement commission, but the additions have come to be deleted by the tribunal. Kirit Champaklal Shah, tax publication, direct tax, 331 Ahmedabad Tribunal. And the other is unreported judgment, Rajesh N. Desai, ITSS number 150 and 151 of Ahmedabad 2023. Of course, the base they have taken is Kaushik Nanubhai Majithia, which I earlier referred to. But yes, these people definitely have a good case if he's being visited with addition, but only at appellate stage. Assessment, nobody will probably accept. Ahmedabad Tribunal, tax publication માં જ ખાલી થયેલું છે, taxman ને બધામાં નથી થયેલું છે. 2025 year. Tax publication, bracket DT, 331 Ahmedabad. ITA number nothing. And Rajesh Desai, ITSS number 150 and 151 / Ahmedabad / 2023 dated 26/11/2024.
The assessing officer issued notice under section 148 for the assess figure 1516 without mentioning the document identification number DIN. Subsequently, the AO issued the separate intimation letter of human date with DIN whether the reassessment proceedings initiated with notice not carrying document identification number is valid or not, invalid and without jurisdiction. With this query, I reminded of the public statement made by the finance minister. अगर आपको कोई भी नोटिस समन्स विदाउट दिन मिलता है तो you throw in the dustbin. It has no evidentiary value. It cannot be considered as the valid notice or any summons or letter. Now in this query, the first notice, statutory notice under section 148 issued by the AO without DIN, there is a civility circular, very useful circular number 19 of 2019 dated 14th of August 2019. It is reported in 416 ITS statute 140. And now various courts and tribunals have also decided that without DIN, any notice or order passed by the tax authority, it has no evidentiary value and without jurisdiction. And recently in the Bombay High Court in Exeter also, Bombay High Court has taken this issue and held that the notice without any DIN, it is invalid and without jurisdiction.
Question number 26. It's a very simple question comparatively. That whether the proviso to section 68, which is inserted with effect from 1/4/23, is retrospective or prospective. This, friends, is regarding the loans and borrowings. That whether the source of source is required to be proved or not. They inserted a proviso for loans or borrowings also, that now we are required to prove the source of source also. But fortunately it is introduced by Finance Act 2022 with effect from 1/4/23. So now the decided case law is that it will be effective from assessment year 23-24 onwards and it will not have a retrospective application. Now earlier, friends, we know that we had that cases of share application money, and there also they had inserted a similar proviso with effect from 1/4/2013 that for share application we are required to prove the source of source also. And that was introduced with effect from 1/4/13. At that time also similar controversy had arisen that whether that proviso is retrospective or prospective. And there we have the Bombay High Court judgment in the case of Gagandeep Infrastructure, 80taxman.com, page 272, Bombay High Court, which said that that earlier proviso is prospective and it does not apply to prior to 1/4/2013. Similarly, this new proviso is also prospective. For that we have a couple of tribunal judgments now. To the best of my knowledge, they are not reported, but I can give you the ITA numbers. ITA number 3148/Mumbai/23, Canberra Infrastructure, and ITA 440 Bangalore 2024, Vastimal Bhimraj Sancheti. So friends, this is in line with the proposition of the Supreme Court that whenever such amendments are made which are, casting a heavy burden on the assessee, they cannot be treated to be retrospective. Had it been an amendment to reduce hardship or to remove an unintended hardship caused by the department, caused by the act, then it is a retrospective application. For that we have that Vatika Township old Supreme Court judgment. So this is in line with these decisions, that such type of amendments which cast an additional duty on the assessee or an additional burden on the assessee can never have a retrospective application. It is always to be treated as prospective in nature. So friends, with this was my last question for the evening. So before I part, I sincerely thank the organizers for giving me this opportunity, for sharing my thoughts, and thank all of you for a patient hearing. Thank you.
So the next question is regarding the tax audit. I think one very important proviso which is mentioned in 44AB. So I think when you were referring to the new bill in the beginning, so there is a paragraph in 44AB which talks about first 44AB subclause A talks about that the limit is 1 crore. Then if you have more than 5% receipts in more than 5% in online mode, then I think the limit is up to 10 crores. Now there's a proviso there, and it reads that provided further that for the purpose of this clause, the payment or receipt as the case may be by a check drawn on a bank or a bank draft which is not account payee shall be deemed to be payment or receipt as the case may be in cash. So now this proviso was inserted in 2021 and most of us fail to recognize this. I think so. What if tomorrow if you go to a client's place and tell him that please give me a proof that all the payment that you have made or all the receipts that you have got, which are not of course not RTGS or NEFT, but if they are through checks, and if he is not in a position to give you the information whether they are through account pay or not, then in that case there is a view that they might be considered as in cash. So in that case the limit becomes again 1 crore. So even if your turnover is 1.5 crores and in that case this proviso is applicable, then you are supposed to get the books of accounts audited under section 44AB. Now surprisingly this proviso is not there in the new bill. So if you read section the clause 63 in the income tax bill 2025, this proviso is not there. Rest all the provisions of tax audit and presumptive taxation are the same. Now, one important thing is, two important things when you talk about 1 crore and above. TDS rates are applicable now because I think earlier they were linked to 44AB subclause A and B. Now they have specified 1 crore in case of business and 50 lakhs in case of profession. So irrespective of your audit or not, TDS will be applicable. And one also very important thing is, what if tax audit is not required and then also tax audit is getting done? That is also something which is wrong. We have 5 subclauses of 44AB, subsections of 44AB. Tax audit has to fall in one of the clauses, one of the subsections. If it doesn't fall there, then we are not supposed to do tax audit. So what is the way out? A lot of CAs and they come up to us and tell us that the bankers ask us to give a tax audit report or maybe audited balance sheet, signed financials. So in that case, there is a SRS 4410, standards on related services, which talks about compilation engagements. So SRS 4410, we can give a compilation engagement, we can give a report based on that, and we can give a signed financial that we are not expressing any opinion on that. We are only giving a compilation of the financial statements that is accepted by the bankers. So that is again a unit generated document which is accepted by the bankers. So if tax audit is not applicable, we should not give tax audit report, rather we should use SRS 4410 and give a statement of compilation engagements. Thank you.
Serial number 28. Notice under 148AB was issued for the AY 1920 and the date of notice is on 31st March 23, requiring taxpayer to respond the same on or before 10th April 23. This notice was based on the information that there was some accommodation entry from MA Marketing amounting to rupees 47 lakh. Taxpayer duly responded on 10th April 2023. After considering the response of taxpayer, AO issued notice on 17th April 2023 under section 148 along with the order pass under 148 AD. Now taxpayer contends the said notice is invalid since it has been issued beyond the expiry of 3 years from the end of relevant AY. And the amount escaped is less than 50 lakh. So here you see the amount of income which is likely to be escaped is 47 lakh. That is less than 50 lakh. If it is less than 50 lakh, then maximum time limit for issuing notice is 3 years from the end of AY. So our assessment year is 1920. If we take it 3 years from the end of AY, AY is 1920, this is 31st March 20 plus 3 years. The last date is 31st March 2023. Now if you see, the date of notice is 17th April 2023. You see 148 is given on which date? 17th April 2023. And therefore the argument is that this notice is beyond the expiry of 3 years and therefore it is less than 50 lakh, extended jurisdiction is not available to the officer. This is the argument. Now, there are two proviso, 5th proviso and 6th proviso to section 149(1). I am reading this proviso first. 5th proviso says to 149, subsection 1, that for the purpose of computing period of limitation as per this section, means for the purpose of computing 3 years or 10 years, the time or extended time allowed to the SSC as per so-called notice under clause B of section 148A, or period during which proceedings under 148A get stayed by an order of any court, that time shall be excluded. So whatever time given to SSC for responding notice, that time AO will get extra. So you look at here, that notice under 148AB was given on 31st March 2023. And time given to reply notice was 10th April 23. So those 10 days, assessing officer will get extra primarily by 5th proviso. That time should be excluded. Now what 6th proviso further says? 6th proviso says that provided also that where immediately after exclusion of the period referred to in immediately preceding proviso, that means after excluding period mentioned in 5th proviso, a period of limitation available to AO for passing order under 148AD is less than 7 days. If AO is left with time limit of less than 7 days, then such a remaining period shall be extended to 7 days after SSC files his response. So in this case, SSC filed response on which day? 10th April 2023. Therefore, AO should be given at least 7 days time to issue the notice, and that is 17th April 2023, and therefore this notice is valid. It is not beyond 3 years, and you can have a direct citation on this. Delhi High Court, Raminder Singh. I request to note down the citation, 156 taxman.com 148. 156 taxman.com 148. I'll tell you there is Calcutta High Court also, but I didn't find it honestly as a practitioner a convincing argument. I have not brought that citation, but you should refer. There are 2 judgments available on this 5th and 6th proviso, reported judgment. So this is notice is valid in view of the 5th and 6th proviso.
This is my last question, and I thank the organizers for inviting me and allowing me to share some of my thoughts today. And I'm indeed more astonished by this fact that today we again got a SMS that your next 2026 is on 6th and 7th. So, I mean, this is the only institution which is hyperactive. It's not active, it's hyperactive. And congratulations to this entire team for this splendid effort which they have been putting year after year. This is a ghar ki kahani question. Assessment has come to be reopened on the ground that A has taken bogus purchase bills from accommodation entry providers. AO has issued a show cause notice proposing to make an addition of entire purchase as unexplained income. Please advise A on this proposal. So this is a very regular notice which we have been consistently receiving over a period of time. GST authorities are forwarding information that we have got this list. They have passed on bogus input credit, this, that. Now, what should be your strategy in case where you receive? If your books of accounts are audited, auditors have not qualified the report. That would be one positive aspect. If you are maintaining a regular inventory register, place it before the AO during the course of assessment proceedings. Identify that this is my alleged bogus purchase, and this is reflected and it is finding its source to these sales. The sales which have been made are acceptable, then how can there be not a corresponding purchase? This is not a correct view which is being taken. Do not much harp on the fact that please point out any defect, because let him, if in 99% of the cases they will not reject the books of accounts, but they keep on just making additions. There are obtain number of decisions where if your books of accounts are not rejected, but they make an estimation of profit, either 100%, it may be 20% or whatever. your additions may get knocked down. The Gujarat High Court decision is also to that effect, which I shall share in a short time. So therefore, and place on record your earlier year's book results. If they are consistent, and if earlier year book results have been accepted, then you would stand a fair chance. Now, whether the action of the AO that I will take 100% is right or wrong, it's actually a freestyle wrestling જેવું છે આમાં. તમને you will get decisions of all kinds. તમને ન એડિશન થાય કે I have been able to, reconcile my purchase with the sales, and you have accepted my purchase, my opening, you have accepted my opening stock, my sales, my closing stock, then why are you disturbing my purchase? So that kind of a decision is also there. Estimation of profits, which may be, on an ad hoc basis, 5%, 7%, 12%, those are kind of decisions are also there. Then there are decisions to that effect that whatever is your GP on your regular business conducted, that only GP you should estimate. And then there are decisions where 100% additions can also be made. Now coming to the first issue, that Bombay High Court very recently and of late has been taking a consistent stand 100%. They are not accepting. Earlier, even Bombay High Court had given various decisions that no, there will be an estimation of profit because there cannot be 100% profit. But Bombay High Court of late and Bombay Tribunal also, they are right now very averse to this proposition. And Kanak Impex, this is the most recent decision, 172taxman.com 283 Bombay, where they said that no, we'll add 100%. Now how, and the reasoning is not very convincing. They said that you have received a bill from X, goods may have come from Y, but you have made payments to Y from whom the goods have come because you had unaccounted cash with yourself. You have first given that cash to him, then you have got the bill, and then you have sold the goods. So your cash flow is earlier, and therefore there is 69C, and this 69C nobody has argued, and therefore we are confirming the addition. But the Bombay High Court, I think, has lost sight of the fact that I have given payments to those bogus bill people. It is out of that probably the cash could have come back to me, and then I could have made the payments to those. But this entire argument, whether it has not been taken or not accepted or not considered, is, and so therefore this decision is 100% purchase to be added. Supreme Court in the case of Zahira Khatun, 172taxman.com 473C, they say that if certain payments are made bogus, then to that extent, even if it is a bogus purchase, whatever is your regular GP on the purchases, only that should be taken. So they have come out with this estimate that your regular GP we will add to your unaccounted purchase. That similar judgment again on that basis has been followed by Supreme Court in the case of Anil Jagannath Tiwari, 153 taxman 540. And Gujarat High Court has given an earlier decision. In case of, if it is what, Pankaj Jain or Bipin Jain? Pankaj Jain. Consistently, Gujarat High Court, who was an acclaimed accommodation entry provider, Gujarat High Court has taken a consistent stand of 6%. And earlier, in one Gujarat High Court decision, in the case of Tejua Rohit by Kapadia, 256 taxman 213, Gujarat High Court has made a nil addition. They have accepted that if it is bogus purchase, it is bogus purchase. You have not been able to establish that this money has come back to me or there is some inflation also. So therefore, they have accepted. So it's a freestyle. Anybody is proposing whatever they want. But these are basically guidelines that how you can approach and what kind of records you place before the AO so that you can minimize your risk and incidence. So 256 taxman 213. Alternative tax citation 94taxman.com 325. Tejua Rohit by Kapadia. And once again, I thank all the organizers for this lovely invitation and allowing me to participate today. Thank you.
Now question is on explain the meaning of the notice issued dispatched and signed. The three terminology, I think one full session is required to understand and interpret three terms: issued, dispatched and signed. This query is very relevant in my opinion, because nowadays, and if you read the new income tax bill, in that new income tax bill also, the important provisions of Information Technology Act has been inserted now. So we have to read both the IT Act, Income Tax Act, as well as Information Technology Act. The terminology issued, dispatched and signed now defined under the Information Terminology Terminology Act, and in many judgments, the courts have tried to define this terminology. What is the meaning of issued, dispatched and signed? Many a times the income tax authority in the regime of faceless assessment and faceless appeal, they simply load the notice on the IT portal, whether it is dispatched or not. So notice shall be termed as issued when dispatched for the service of it upon the assessee concerned, and not when merely signed. Means merely signing of the notice, it cannot be termed as the issued. It can be termed as issued when dispatched for the purpose to reach to the assessee concerned. I have tried to find out some relevant decisions. So citations are Sumanjit Agrawal, 449 ITR 514, Dauji Abhushan Bhandar Private Limited, 444 ITR, page 41, Allahabad High Court. Then Madras High Court, Srimati Parveen Amin, 446 ITR 201. Then Telangana High Court, Kalyana Chilara, 465 ITR 729. These are some of the judgments in which the court have occasion to interpret this important terminology. What is the meaning of issued, what is the meaning of dispatched, and what is the meaning of signed. So we have to, 449 ITR 514, 446 ITR 201, then again 444 ITR 41, and 465 ITR 729. This is also the last question allotted to me. I really appreciate the patience of the participants in this technical session. They have checked the brains of the trustees on the dais, and we have tried to give full satisfaction on the queries raised by the participants. At the same time, I express my sincere thanks to the organizations, the President of the All Gujarat Federation, Dr. C.A. Vishwasha, and the IT Bar Association President, Mr. Sridhar Shah, and all the team of both the association and all of you. Thank you very much.
Everybody is concluding last. I think I am last of last. Serial number 31. Ankur is in receipt of 148 AB notice dated 1st March 2025, along with some set of information which suggests that income chargeable to tax had escaped assessment. Annexure disclosed information like this, that he had deposited cash of 33,62,000 with Syndicate Bank and another cash of 26,13,000 in the same assessment year with Punjab National Bank. So put together it is 59,75,000 cash deposit. Ankur filed reply to the so-called notice stating that the first cash deposited is correct, it is 33,62,000. But second one is not correct. He said that he had given the copies of bank statement also, that I have not deposited second cash which information you have got. Therefore, second information is incorrect. Now this is which assessment year? You can pay attention. Assessment year 2021. Now, claim of the AO is more than 50 lakh, and he is giving notice on 1st March 25. That is beyond the expiry of period of 3 years. But Ankur placed on record that my cash deposit is only what? 33 lakh, which is below 50 lakh. And therefore, ideally, AO does not have extended jurisdiction. But still, we know that order has been passed. Generally, order is being passed. Like Aseem already said that at assessment level, nobody will give you favor. So this similar set of circumstances and facts came before the Rajasthan High Court. Many judgments are there on that. I request you to note down citation. 159 taxman.com 306. I repeat, 159 taxman.com 306. Bijendra Singh versus Income Tax Officer. Para 22, I am reading that judgment. Court clearly said that from the given facts, though notice was issued on the assumption that cash deposit were more than 50 lakh by invoking extended period of limitation as a fact, it was found that same is below 50 lakh. And once said aspect is clear to the authority lost its jurisdiction to further continue with the proceedings. The court is very clear that once facts are clear that it is below 50 lakh, then he cannot continue the proceedings in view of the limitation under section 149(1) of the Act of 3 years would trigger and authority would lose jurisdiction on account of limitation as the amount was less than 50 lakh. So with this, I think we are concluding the brain trust posers. I am thankful to the organizer, All Gujarat Federation of Tax Consultant Income Tax Bar Association, their committee members and the participants from across Gujarat. I am thankful to the all trustees who had also showered knowledge and experience on all of us. Thank you all.
We thank all the dignitaries for the brainstorming and the insightful session. I'm sure the session was a fruitful one for each one present here. This leads us to the end of the last session of day 1 of the 2-day Tax Conclave 2025. All the dignitaries on the dais are now requested to move ahead for a group photo session. As we come to the end of the first day, I would like to make an important announcement. Thank you. Have a good day.
Good.